Jones, welcome to Market Outlook, Trends, Risk Events, and Trade Setups brought to you by Vantage Markets. This is a weekly webinar where we focus on the key events and themes driving markets at the moment. Whilst I just let you have a quick look at the disclaimer, I'll just run through shortly what we hope to get through in the next 30 to 40 minutes or so. It's an absolutely packed webinar, in fact. With so much going on, the kind of last hurrah, if you like, for major central banks, the Bank of Japan, the Fed, and the Bank of England meeting this week, of course, as well as then some top tier data in the form of Eurozone inflation data. And also, it's the first Friday of the month, of course. So we get the US employment report, the non farm payrolls report on Friday, as I said. And we also get big tech earnings. So we get four of the Magnificent Seven reporting across the week, actually, Tuesday, Wednesday, and Thursday, all after the US closing bell. So a very, very big week, actually, in markets, in summer markets as well, we should stress. So always interesting. We think this time of the year, liquidity is thinner, volumes are lower. So you can get more pronounced price action and more volatility because of those thinner markets. It can exaggerate price moves, and often those are sometimes or often those are reversed as we get back into September and when more people are actively at their desks, trading desks, especially in big banks who have taken holidays, of course, over this period. Okay, yeah, here's the format that we'll be following. Pretty standard as usual. So we'll just check out how markets are shaping up currently. We'll then look at these big tech earnings. Before then, looking at some of the technicals around those stocks and the major indices. After that, we'll review just quickly, actually, only a couple of bits from last week. So the Bank of Canada meeting, some PMI data, and some US data. Before then, getting into obviously this big week of central bank meetings, as I say, those three major central banks, as well as that top tier US data, really the marquee data as well, non-farm payrolls, which we'll wrap up with hopefully, and cover all the associated currency majors as well. Currently, then, US equities, stock futures, they're rising modestly after Friday's gains as well. Topsy-turvy week, really, last week, a sell-off, and then just gains on Friday. Tech giants obviously reporting across the week, as I say. Currencies, US dollar really trading modestly bid, mixed really through most of the morning. Focus again on these three major central bank meetings. Commodities, they are showing signs of stabilization really following the July reset, and fixed income, just looking at that, US Treasury yields falling really, potentially on expectations of Fed rate cuts, not this week, but obviously potentially if they lay the groundwork for that, nailed on by markets, at least nailed on September 25 basis point rate cut. We'll jump into earnings straight away, actually, and just check out the fact that if you just bear with me, actually, 1 second, I'll just pull up the S&P 500 chart for you guys to look at first of all. But four of the so-called Magnificent Seven technology stocks that have powered the US market rally for the past 9 months, they've ended actually last week in correction territory. That means they've fallen by more than 10% from their recent peaks. So Nvidia and Tesla are now each down 17% from their recent peaks, while Meta and Google, Alphabet, that is, of course, have fallen 14 and 12% respectively. Apple is the best performer in the group, having lost, well, just 7% from its peak, while Microsoft and Amazon, they've slid around 9% each. So they're pretty close to double-digit falls. That obviously then define a correction. Investors really are looking ahead to these earnings updates this week, really amid worries about punchy valuations and then the risk that returns from these really vast AI-related spending may not actually live up to early hopes. Last Wednesday, Alphabet, they sparked a wider market sell-off when, despite its reporting solid quarterly operating numbers, its shares fell more than 5% on concerns really about AI-related investments. Its $13 billion quarterly capital expenditure was almost double the levels of a year ago. And in fact, I've got a graphic, first of all, that I probably want to show you, which is here. That just shows you Alphabet and Tesla reporting, and then the sort of sell-off that we saw in the major indices. Last week, of course, we also had Tesla's results. The markets really are punishing those that do miss analyst expectations, as Tesla sold off 12% after slowing sales, and AI spend really shrank profits more than expected. And it's interesting, actually, on average, then, companies that missed expectations have seen shares fall around 3.3%, I think FactSet are saying, which is greater than the 5-year average of just 2.3%. And then companies that beat really saw on average no gains, according to FactSet. So really interesting stuff there. And along with this, of course, we then had this rotation, this great rotation, actually, in historic proportion. It is really quite large. Out of large caps, out of growth stocks into small caps and value-oriented sectors. And certainly then the Russell 2000, which is the small cap index in the US, is certainly benefiting from that. That was up 3.5% last week against a 0.8 percentage loss in the SP 500. So a lot of different factors going on. And if we just kind of touch on this briefly, then for sure, we think the sort of carry trade funded in yen, that turnaround really in that trade, which has really driven markets over the last some time, 18 months or so at least. And a carry trade is obviously where trades are funded in yen, which is obviously very cheap. Then that unwind means they're being covered or forced to cover as the yen has gained very recently, and especially last week. That is affecting markets across the board, basically, and simply because, of course, if you think back to the US CPI data, which obviously softened, that then got the Fed in play for a rate cut in September, which is nailed on. We'll get to, of course. And then you have also the Bank of Japan potentially hiking this week as well. So then those interest rate differentials really are narrowing. And then that has caused, as I said, the carry trade to unwind potentially. FX, we saw that because the yen, well, sits at the top of the performance table, really. And then the Mexican peso is at the bottom. That's been the favorite trade, of course, for, as I say, a number of months. Margin calls across then a range of trades where the yen has been a cheap source of funding, basically. So stocks, gold, crypto, reflected really the broad impact really of what is now this classic carry trade unwind. As I say, stocks then are being affected, and we're also then seeing that great rotation out of growth stocks as well. So a lot is going on in the markets at the moment, we think, and especially with these tech earnings coming in, as well as then all these major risk events with the central bank meetings coming up. As for the specific earnings, Microsoft is first up, actually. If we just look at some of those stocks on the chart, actually, as well. Here's Microsoft chart from pretty much this year. You can see falling through. Yeah, I've got a fib level from the sort of lows in October. You can see there we fell down through the first sort of fib level. We're just below now, just trying to hold on to the 100-day moving average at 426.41. This is in Microsoft. It's up still over 13% year to date, which is beating the S&P 500 index, the broad benchmark, if you like. Microsoft remains the biggest single stock in both the S&P and the Nasdaq 100, index weighting around sort of 7-8% or so. It's also the third largest stock in the Dow. Over earnings, which is most important, options I think imply a move of plus or minus around 4%. Though recently that has been somewhat mixed with a sort of 50-50 split of post earnings advances and declines over the last 8 reports. Consensus for this quarter sees EPS, adjusted diluted EPS, that is at $2.94 on quarterly revenues of $64.5 billion. So that's Microsoft. As I say, potentially the next fib level is around this support level here at 407.65. You've got the 100-day moving average of 426.41. That's the 50-day, the blue line at 439, with the highs obviously above 460. Microsoft then, they report after the closing bell in the US on Tuesday. Then we get Meta, which is obviously Facebook's owner. They report on Wednesday after the US bell, closing bell, that is. Again, they are up much more substantially, around, well, above 30% higher this year now. So that's the best performing stock in the S&P 500 communication services sector. And I think around the sort of 23rd or so best performer in the index at large. Size-wise, Meta, of course, around the 5th largest in the benchmark index and around the 6th largest in the NASDAQ. Derivatives, then, they imply a pretty big move around sort of plus or minus 8.6% or so in Meta in the 24 hours following the second quarter earnings release. As for the exact numbers, consensus, they see quarterly EPS at $4.74 on revenues of $38.3 billion. Again, looking at the technicals, we've got this swing low in here after the gap higher in February. That's at around where 453 on the nose. Actually, we dipped below there, but then that acted as support again. So decent support, initial support at least at 453. Obviously, we're around 465 at the moment, so an 8.6% move or so will take it below that. We've got the 200-day moving average at 829.63 at the moment, and then we got this cycle low really from late April. That's at 414.50. Otherwise, the upside, you've got the 50-day and the 100-day moving average around $490, $491. Before then, that all-time high at 542.81. After Meta, we get Amazon and Apple out after the close on Thursday evening. That is US time, UK time. Amazon, that trades around 16% higher in 2024. So outperforming the S&P 500, around the 9th best performer in consumer discretionary in that sector, I believe, at the moment. It stands around the 4th largest single stock in the S&P 500, Amazon, 5th largest in the NASDAQ. It is also a Dow constituent as well. Options, they imply around a 7% move plus or minus in the 24 hours following the release. And recent post-earnings performance has been strong, with the stock is ending the session following the quarterly report in the green for the last 4 quarters in a row. This time, EPS, that's expected at $1.03 on revenues of around $148.74 billion. Again, we've got levels here which go back to 2021, actually. So that's interesting. Major level there, that previous high, which sort of acted as resistance before. That's at, I think, 183.89. No, it's not. It's at 188. Sorry, it's at 188.65. That previous high from 2021. Just pull it back. You can see it there. Acted as resistance a couple of times, and also then this year as well in April and May. We did get higher, of course, but we've got a major barrier around 200. This is for Amazon. Couldn't get through it, even though we're tracking. Looked like the pressure was building for a break higher, but then we pulled down below 188.65 below the 50-day moving average actually as well, which sort of solidifies that zone of resistance. 187.14 the 50-day. The 100-day, interestingly, that's sort of acted as support a couple of times. You can see that's at 183.89. You've got the 200-day moving average well below that, which probably tallies with the 200-day. So that swing low there is at 166.32, 200-day at 167.30. If we do get a massive move, initial support potentially at that May low at 173.87. Okay, those are those stocks. If we just briefly look at the indexes as well, S&P 500 obviously sold off, but just tagging this long-term trend line. Depends where you put it, really, and these closes, but we're just holding on to that long-term trend line support, if you like. We've got a fib level in here of the sort of April up to the July highs, and we found support at the 38.2 at 53.96. We've got 5,500 as a minor fib level, but that also tallies with that trend line. So interesting levels here for the wider index. For the NASDAQ, again, we've got in here the fib levels, short-term fib levels, really. We tapped the 100-day moving average on the NASDAQ at 18,687, found support there. Halfway move of this April to July high is at 18,832. So then potentially some support as well above here. Next fib level, 19,271. And then the 50-day moving average is at 19,433. The Dow, you can see we've got in that swing high there, which is at just above 40,000, sort of reinforcing that sort of zone of support around the 38.2 fib retracement level at 39,941 as well. So that acts as support, and potentially then we're looking at the all-time high again, which is at 41,376. Okay, last week's data, just briefly, we'll run through that. European PMIs, first of all. Just got a chart. Here we go. Here's what we're looking at next, which is a review of last week's data, as I say. First up, PMIs. And you can just see we used this last time, but hasn't quite updated, but gives you a good idea. Red being in expansionary territory. This is the composites PMIs across the globe. Blue being in contractionary territory, which is below 50. European PMIs, they were weaker, actually. So weaker on a manufacturing, falling again to 45.6, really illustrating the ongoing weakness in that sector, while services actually slid as well, although they did remain in expansionary territory of 51.9. The composite then, that dropped to 50.1, so very, very close to that 50 threshold from 50.8 in June. And the fall really points to more weakening of economic activity at the start of Q3. Kind of only positive was probably that selling prices expectations softened. But we also note, actually, the recent ECB meeting saw official language change so that risk to the Eurozone growth outlook was no longer balanced, but actually tilted to the downside. So these numbers really reinforce that. They relate to Q2, but could mean near-term growth forecasts have to be revised down in September. And that is important for the ECB and potentially another rate cut at its September meeting. Not good news, really, then. UK PMIs, they, in contrast, held up quite strongly. Manufacturing came in higher, 51.8 versus 50.9. 51 was expected. Services as well, they tipped up to 52.4 from 52.1 previously, although that was a touch lower than the expected 52.5. So decent enough numbers, really, from the UK. As I say, contrast really to Europe now. This flip really with as well on the political front as well, you might like to say, with UK obviously stable governments, Labour landslide majority, of course, and then European politics suffering with France, essentially no government in place as yet, and Germany as well, slightly uncertain picture going forward. Otherwise, US flash PMIs, just touch upon those. Those were mixed. So manufacturing fell to a 7-month low, and is back in contractionary territory, so not great. But then services rose to a 28-month high at 56.0 against an expected 55.0. Good news, prices metrics, they eased, and that kind of signals this sort of Goldilocks scenario, soft landing, remains in place at the start of Q3. Also, last week we had the Bank of Canada meeting, and if I just pull up a chart of dollar CAD, if we move on to currencies, which you can see here, successive days of gains for the dollar against the loonie. So the loonie suffering really. Bank of Canada, well, they cut its rate from 4.75% to 4.5%. Really was about what Governor Macklem said. New forecasts, they showed that excess supply in the economy has increased. Household spending, including both consumer purchases and housing, have been weak, and there are signs of slack in the labor market. CPI, that eased to 2.7 in June after increasing in May, while the central bank's preferred measures of core inflation have been below 3% for several months now. As I say, Governor Macklem was key. He sent probably two slightly dovish signals. He kind of partially shifted the focus from inflation to growth risks as the Bank of Canada signaled potentially more cuts ahead. And then he also sounded quite relaxed on the widening Bank of Canada sort of Fed gap, really. And that means that a cut in September, which is 2 weeks before the FOMC meeting, is possible should the Canadian data continue to deteriorate. And certainly if, as expected, the Fed go ahead with their rate cut, then you would think that is likely as well. And as I said, Macklem is fairly relaxed about that gap, which has widened out recently. Dollar CAD, then you can just see Wednesday was the meeting, and we just carried on going higher. The Canadian dollar weakening, and we're now into really sort of serious resistance levels. 138.46 was the year-to-date high from April, and we got to 138.49 last week. You can just see there we are slightly overbought now on the RSI. Doesn't mean we can't go higher, of course. You can see here, but generally, potentially, we will have some sort of correction. Otherwise, this high here, 138.98, will be important as well. And then we have the high from October 2022. I'm just pulling it back, which is at 139.77. But yes, interesting levels here as we go into the Fed, of course, as well. US data otherwise, GDP, that re-accelerated in Q2, kind of largely as anticipated. So growth came in at 2.8, annualized, twice Q1's number actually of 1.4%. Underlying the headline result, private demand growth was broadly the same actually in Q1 and Q2, modestly below the 3% average of the decade prior to the pandemic. Interestingly, at 2.3% annualized consumption growth was also consistent with the pre-pandemic average of 2.4%. Though for the past 6 months, at least, growth in this sector has relied solely on services. Friday as well, last Friday, that gave us the Fed's favored inflation gauge, the core PCE deflator. That came in, well, rose 0.2% month on month above the prior revised 0.13% and forecast of 0.1%. The year-on-year print that rose by 2.6%, matching the prior month pace, but above the 2.5% forecast. The annualized metrics, they saw the 3-month tick down to 2.3% from 2.9%. Headline numbers, they were in line with expectations, rising 0.1% month on month, 2.5% year on year. I think key really for this data then, 10 of the last 13 months have produced average month-on-month inflation of actually 0.168%, and that is really equivalent to a 2% annual rate. That's exactly in line with the Fed's target, and actually exactly what we've been saying for many months, that we need readings around 0.17% actually, to 0.2% if you look at the headline and then check the rounding over a series of months to then get back to 2%. And that's where we are with this core PCE data. Okay, let's move on now to this week's main events of the week. Firstly, we will look at the Bank of Japan, and I'll just pull up the dollar yen chart, which has been fascinating, really. I mentioned it at the top of the webinar, really, and what's been going on with the unwind of the carry trade for sure. But the Bank of Japan will play a part in where the yen goes, of course. Could this be the second rate hike of the cycle after the bank raised its target rate in March? And then will the Bank of Japan cut back on Japanese government bond purchases, JGB purchases? And if so, by how much? We'll find out this on Tuesday, of course, when the statement lands, and then during Governor Ueda's ensuing press conference a few hours later. The implications for markets could be quite stark, we think. A hike to the unsecured overnight call rate could add further trend strength to the yen, and that would be disruptive to the carry trade out of cheap Japanese borrowing costs into more attractive yields elsewhere. That could be incrementally destabilizing, and we really think this to bond markets and also then stock markets as well. Of course, the impact on markets will also depend on Governor Ueda's guidance, and certainly if we get, say, even a hold with cagey guidance, that could really take some steam out of the yen and motivate really incremental buying of higher yielding bonds abroad, and then a carry trade would potentially carry on slightly, and we may see a bid in risk assets as well. As I say, depends on Ueda's guidance. Out of 46 forecasters within consensus, only 9 expect a Bank of Japan hike. In contrast, really, markets, they're assuming a higher probability to a 10 basis point hike. That's been floating around sort of 70% or so odds, with around 6 to 7 basis points priced in. There was 7. I think it may have just moved a touch lower, but around 60 to 70% chance markets think of a 10 basis point hike, whereas analysts much more divided and really not expecting a hike. That case for that move really rests entirely upon gauging really the degree of the Bank of Japan's confidence that it is durably on the path towards achieving 2% inflation over the medium-term horizon, while also getting further distance away from the distorting, really near zero policy rate of 10 basis points. Of course, the sluggish economy, which we're seeing, and concerns about weak consumer demand could justify the need for caution, particularly when inflation, whilst above target, is far from being rampant. In fact, actually, Tokyo core CPI, the most recent data, that just reversed prior progress towards firmer readings, which kind of sends a cautious signal. And then, of course, we had the yen's really impressive rebound in July. That potentially provides policymakers with some breathing space on really the urgency of rate hikes. Interestingly as well, we've heard a lot about wages in Japan, but potentially there is not a great deal amount of evidence that Japan is really escaping the grips of falling real wages. So while those shunto rounds of negotiations with unions have driven a sharp acceleration of wage growth over the past 2 years that we've seen, that's really concentrated in less than 20% of Japanese workers. And the evidence this is spilling over into lifting wages elsewhere is actually quite limited. And then also oil prices, they've sort of ebbed somewhat of late, but more importantly, have been broadly trending sideways through much of the year. And remember, since Japan imports so much oil, the pass-through to inflation risk has kind of ebbed as well. Yeah, really interesting meeting, we think, for many reasons. Even if there are no surprises, on Wednesday, and the only announcement is the expected decision on scaling back bond purchases. It's kind of unlikely that policymakers would risk sounding too dovish, as this could then derail the yen's recovery, possibly. The latest bank's outlook report as well may offer some additional clues on the future policy course in such a scenario. Nevertheless, given the scale of the yen's rally, a hawkish hold could still trigger some profit taking in yen crosses. So, yeah, interesting meeting for dollar yen. 152 is absolutely huge. If we just pull this back, you can go back to, I don't want to go back too far. You go back to October 2022 and then October 2023, November 2023 intervention levels here. Well, especially in 2022, of course, we had intervention. We thought we had intervention, but not in 2023. But then we've had it recently when we went up to 161.95 and 160.21. But yes, you can see how big potentially then the level which we tapped last week at 152, just around there, is absolutely huge. There's a lot of dotted lines on here, but hopefully you can see that big 152 level. You've got the 200-day moving average just below there, 151.60, sorry. You've got the 100-day average just above at 155.54. I've got some near-term fib levels in here, really, which probably are more useful than these longer-term levels. I'm just checking here. You've got a longer-term level of 153.66. If I just take that off. And then this near-term level, which is between the sort of intervention levels and that recent high at 161.95. So yeah, we're around a minor fib level at 154.01. Next one would be at 155.71, which just about tallies with the 100-day moving average at 155.54. Yeah, really interesting Bank of Japan meeting, we think, for multiple reasons, as we've said. Okay, let's go to the Fed now. And we have a graphic really of all the main numbers. No changes expected, so rates will be kept at 5.25 to 5.5%. The decision is in between the June and September forecast rounds, remember, so there are no dot plots, no dot plot updates, if you like, of interest rate expectations. Stronger than expected growth, really, and hotter than predicted inflation in the Q2 GDP report. They failed to really dent market expectations of interest rate cuts from September. That means the Fed is probably expected to pretty much lay the groundwork for such a move at this meeting, as policymakers express growing confidence inflation is on the path to 2%, and that economic challenges are more and more of their focus. The data is also expected to point towards policy easing with, well, we get employment costs actually there seen moderating, business surveys cooling, and of course then the all-important jobs report indicating growing slack in the labor market. All that said, though, some think the FOMC may want to express a bit more flexibility, as they will still have 2 rounds of CPI reports and 1 more PCE data report, plus as well 2 more jobs reports between now and the September meeting. There is, of course, this soft patch in core inflation over the last couple of months, but rate setters, they may, on the flip side, want to sort of have this truly greater confidence of making progress towards that inflation goal, so need more data. Otherwise, you could see possible tweaks to the statement that could come in the opening paragraph, where I quote, "There has been modest further progress towards achieving the 2% inflation target," or something that signals more confidence. And then also on the third paragraph, reference to the committee holding off on rate cuts until it has gained greater confidence that inflation is moving towards 2%. That could be strengthened to signal that is being achieved. If so, yes, they are certainly then lining up a September rate cut. Markets, they have, well, fully discounted the September move to 5% to 5.25%. Additionally, they fully priced the Fed cutting rates again by the end of this year, and there's actually around a sort of 50% probability of a third rate cut this year. That's obviously in stark contrast to the June economic projections, the dot plot, the medium dot plot, where policymakers penciled in just one cut this year. So really interesting, actually, because whether Powell then pushes back against that. He has really, up until June, actually, with that dot plot, he's been reliably dovish. So it's interesting whether he will then go back to that kind of stance. If, of course, things pan out, then as the markets expect, really, then kind of think the Fed will use the Jackson Hole Symposium and listen to that will come into sharp focus, really, we think, in the next few weeks. That's, I think, end of August, around 22nd, 23rd. Jackson Hole is a symposium where Fed policymakers meet at the end of the summer. Potentially then they show they're re-evaluating the outlook and will be cutting their growth and inflation forecasts at that September meeting with those updated dot plots. That then may raise the unemployment projection as well, and then signal essentially a September rate cut is going to happen. We've just got here then the current sort of pricing, which you can see moving lower, of course, with these rate cuts priced in. As I said, sort of 50% chance of a third rate cut happening. So 2 already priced in, with 1 in September. Yeah, 1 in September. As for the dollar, if we just check that out, well, short term, the direction of travel certainly in US short-term rates is lower. And then if we think about short positioning in dollar yen, risks are, well, potentially to the downside in that. But certainly if we do get a cautious outlook, possibly, then perhaps the dollar won't move too much, because essentially we will have Jackson Hole as well as another opportunity for the Fed to signal their intentions for the September meeting. DXY, this is the dollar chart against 6 of its major trading partners. You can see we're just up just above this fib level, 104.26, which is the 2020-24 move. You've also got the black line, which is a 200-day moving average at 104.33. If we do break to the upside, then we've got the 100-day and 50-day moving averages around 104.85, 104.88, potentially as initial resistance. Before then, a minor fib level at 105.25. Otherwise, downside, potentially support seen at 103.65. 103.56 is the next fib level, which is the halfway point of the December low up to the sort of April high. Okay, that's the DXY. Moving on, we do also have the Bank of England meeting. And again, we have a graphic with all the sort of key numbers, we think. Interesting meeting, potentially. That Bank of England, of course, the third of the week's biggest central bank to meet. They come in on Thursday, Fed obviously on Wednesday. Markets, well, they're pricing half of a quarter point cut. So essentially a 50-50 coin toss. Bloomberg consensus, though, is more convinced that a rate cut will be delivered, with around 75% of forecasters expecting a cut. Interestingly, the lack of really recent communications from BOE officials does maintain significant uncertainty into this meeting. Though we know from the last meeting that the June decision to hold rates was finely balanced, as they said. Here, well, 7 MPC members, including Governor Bailey, opted to hold, with 2, Dingler and Ransman, preferring a cut. And then of the 7, if you think 2 or 3 probably are visibly resistant to cuts, which then leaves 4 or 5 in the middle who could have gone either way. Have they changed is key. We have heard not very much, as I say, only from a couple of hawks, Mann and Haskell, while Chief Economist Pill, I think he said we have to be realistic about how much any 1 or 2 releases can add to our assessment. But generally, yeah, not heard a great deal. And otherwise, data hasn't been clear cut either, really. And certainly, if the MPC remains more skewed towards data dependency over forecasts, then yeah, quite mixed. GDP, that was solid at 0.7%, annualized in Q1, non-annualized, sorry, and 0.4% month on month in May. Core CPI then over the past 2 months has been running a little hotter than like months in history. We've had headline, of course, hit the target at 2%, but it's really all about services inflation, which is still high, 5.7% against the MPC's recent forecast of 5.1%. Although some economists are calling that due to a spike in hotel prices, as well as some other noise in there as well. Potentially the core services inflation number that has fallen more aggressively this year and is on the MPC's most recent forecast of 5.1%. So just some interesting detail there. Wage growth, though, does remain warm. The headline right, as I put here, at 5.7%. While PMI, composite, and manufacturing services sectors, as I mentioned earlier, are also in expansionary territory. So knife edge really at the moment for Bank of England's rate cut. There are then 2 rate cuts fully priced in by year end. If you just look at this chart here, which is useful really, for seeing where this services number, the blue line, is showing how elevated it is. You've got the similarly wage growth being relatively hot as well. But then that headline number, of course, falling nicely back to the 2% target. It is the key focus, though, as we always say, services inflation and wage growth for the MPC. If we just look at cable, actually, so I was just pulling up a chart here, which I'll get to now, which you can see here. We just fell off that high from a couple of weeks ago, middle of July, 130.44. We've got the 50-day moving average at 127.78. Just easing those overbought conditions, but we're back to sort of 50, just below 50 now, actually. So possibly we find some support around here, which has been previous sort of resistance, which may offer some support around this level. Otherwise, yeah, below 127.78 is the 50-day, and then you've got the 100-day at 126.81. Should really draw some fib levels here. Oh, not that one. That one, sorry. Just roughly sort of initial fib levels you've got at around 127.57, more or less, which is obviously that low in April up to the high in July. Okay, also then we do have, I'll just get to this actually because it is important. We do have Eurozone CPI data and of course non-farm payrolls. Here we just got a graphic of the Eurozone CPI data. We do get GDP actually out of the Eurozone as well tomorrow. That's expected to show still tepid 0.5% year-on-year growth. Interesting, actually, worth pointing out the latest ECB meeting, as I said, also put greater emphasis on data dependence, really as Lagarde ditched forward guidance. So, key number will be the inflation data. Expectations are for headline to drop 1/10 to 2.4 from 2.5%, and then the core as well seen pulling back 1/10 to 2.8 from 2.9%. Core inflation has beaten consensus actually in 5 of the 7 flash estimates since the start of the year. But just note the prior release failed to change the outlook for the ECB with the core reading unchanged from the prior and the services print still elevated, as we've said here, at 4.1%. This time around, well, a small pullback is seen in price pressures and then potentially could pave the way for this September rate cut odds, currently at 56% to move higher. There are around 55, 56 basis points of cuts still priced in for this year. If we just go to euro dollar, which is here, you can see, yeah, it came into resistance around 109.50 or so, 109.48, that high from mid-July. We're just now tapping the 200-day moving average at 108.20, and then we've got multiple other moving averages around that, plus that fib level, 108.06. A strong, you would think, strong zone of support around there, with that recent high, yeah, at 109.48. Okay, finally, let's get to NFP and a graphic with all the main numbers. Non-farm payrolls, of course. Consensus expects 185, the headline number, versus 206 in June. That's against the 3-month average, as I put here, at 177. And then the 12-month average of 218. Unemployment, that's expected to hold at 4.1% versus, well, the June projections of 4%. In 2024, actually the end of 2024, so we're above that. Many economists have recently noted that, well, it's interesting, this actually, the 3-month average unemployment rate is up 0.43 percentage points, or percentage, 0.43% from the low seen in the last 12 months. And that is close to the 0.5 threshold, which there is a rule, the SARM rule, you might read about that in this week. That rule identifies as a recession signal. So basically that says there will be a recession once the unemployment rate rises 0.5% above its low for the previous 12 months. But just to qualify that, even if the unemployment rate continues to rise by 0.1% in July, for example, although it's meant to hold steady at 4.1%, the SARM rule actually is highly unlikely to be triggered, as the earlier lower 3.5% in July 2023, that will then drop out of the 12-month comparison period, and is replaced with a higher value of 3.7%. So then we'd need to be 4.2%, you would figure. So 0.5% above the 3.7% over the last 12 months, to then potentially trigger that SARM rule, and which is identified basically as a recession signal. Otherwise, average hourly earnings seen at 0.3%, pretty benign month on month in July. We should note, really, analysts will be looking to the Feds as well. The preferred gauges of gauge of wages. That's the employment cost index that's released on Wednesday, actually. So before this NFP data. And that rose to 4.5% in Q1, and signs that it is continuing to decline could be actually more influential than this wage data on Friday. So that is non-farm payrolls. You can see here just the bar chart and then the unemployment rate ticking higher. Of course, the Fed will be wary of that, even though sort of job gains are sort of relatively around the sort of 180 mark or so. 177, as I said, for the 3-month average, slightly higher for the 6-month, but then slightly lower a touch for the 12-month. We will wrap it up there, I think. We've got through a lot. Hopefully that's been of use to everyone on the call. Thank you so much for tuning in. Please do follow us on social media, and also we do post a daily on the website, which has a chart of the day and a sort of more detailed look at the day ahead, as well as a review of the US closes and what that means for markets. A really, really busy week. A lot going on in summer markets. So do take care out there. And we will speak to you same time next week.